Recall that with respect to behavioral biases, we have two broad categories. We have cognitive errors and then emotional biases. We are still talking about cognitive errors, and in the context of cognitive errors, we've discussed belief perseverance biases. So these were the 5 belief perseverance biases that we've gone over. Now we are going to talk about information processing errors. These biases, in other words, information processing biases, result in information being processed and used illogically or irrationally. In contrast to belief perseverance biases, these are less related to errors of memory and more to do with how information is processed. The processing errors discussed in this reading are as follows. So these processing errors or information processing errors are anchoring and adjustment bias, mental accounting bias, framing bias, and availability bias. So over the next few slides, these are the biases that we will talk about. Let's start with the anchoring and adjustment bias. The anchoring and adjustment bias is an information processing bias in which the use of a psychological heuristic influences the way people estimate probabilities. So here people set an anchor which influences their decisions. They might adjust an anchor up or down to reflect subsequent information. Very often, people set an anchor which influences their decisions. So for example, if somebody buys a stock for 25, this initial purchase price might be an anchor. Or if the stock goes up and there is some high water mark, so the stock might hit 35 and then start coming down, people might set this new anchor at 35. So people often change their anchors, but with the anchoring and adjustment bias, the issue is that people do not change or adjust the anchor easily. So the anchor is not adjusted rationally. It's not adjusted to reflect the new information. So that's what we mean when we say anchoring and adjustment bias. So what are the consequences of the bias? With this bias, financial market participants might stick too closely to the original estimate or the original anchor that they set, even when new information is learnt. So going back to this particular example, let's say that someone bought a stock when it was 25, and then this price of 25 is anchored in their head. The stock then goes up, so they are happy because the price is higher than what they purchased it at. But then the stock starts crashing, and let's say it comes down to 15. And let's say that even if the stock is at 15, if we look at the fundamentals of the stock, the fair market price or the fair price given the current financial situation of the company, let's say that that is 10. So if we really look at the information, this 15 is still a good price. But if a person has stuck to this original anchor of 25 and is now waiting for the stock to go back to 25 because this number is anchored in his head, then this would be an example of the anchoring and adjustment bias. Notice that the anchor is set and this anchor is not being adjusted very easily. This bias is related to the conservatism bias which we talked earlier. So remember, the conservatism bias fell under the belief perseverance group, and this bias is related to conservatism bias. In the conservatism bias, people place undue weight on past information compared to new information. In the anchoring and adjustment bias, people place undue weight on an anchored value, which in this example is 25. So how can this bias be overcome? One technique is to continuously ask questions that may reveal an anchoring and adjustment bias. So here, if the question is constantly asked whether this price is reasonable or not, then that can help someone overcome this anchor of 25. The other related point is to recognize that past prices and market levels are not an indication of what will happen in the future. So just because the stock was at 25 originally when it was purchased, and then there is this high watermark or high level of 35, these numbers have nothing to do with what will happen in the future. So the current stock price is 15. The situation over here should be evaluated, and the future prospects should be evaluated in deciding whether this current price is a good one or not. Next, we have the mental accounting bias. People with this bias treat one sum of money different from another sum of money based on which mental account or layer the money is assigned to. So, for example, someone might create 3 layers. The first layer is a layer of very conservative investments, and these investments are, let's say, low risk. Then we have medium risk investments, and then high risk. So now money is allocated separately to these 3 different layers. These 3 layers are being treated separately or differently, and they are being treated as if they are not interchangeable. But the fact is that money is fungible. Fungible means that money is interchangeable. A dollar in this conservative layer is no different from a dollar in the high risk layer. So now, what are the consequences of this bias? One consequence is obvious. Money is placed in buckets or layers, and because people are putting money in separate layers, they neglect the opportunity to reduce risk by combining assets with low correlations. So you might have some high risk investments that have a very low correlation with some conservative assets, and by creating these layers, we are not really looking at the correlations. So these high risk investments are being looked at separately, the conservative investments are being looked at separately, and the fact that there might be a low correlation and therefore a diversification benefit between the investments in this layer and this layer, so that fact is being ignored. Another possible consequence is that people might irrationally distinguish between returns derived from income versus capital appreciation. So for a conservative investment, let's say an investment of 100 is made in a bond and there is a return of $5. This $5 return, which is actually just the coupon payment that might come on a bond, is treated differently from, say, another investment where a stock was purchased for 100 and then let's say this went up to 110. The investor should recognize that if a stock goes from 100 to 110, some of the shares can be sold to generate an income of $5. Also, sometimes people irrationally distinguish between the investment principal and the investment returns. Some participants invest the original principal rationally but are willing to take a very high risk with investment returns. So people say that, okay, we've put in $100 initially and this $100 is kept very safe. But let's say this investment generates a return of 10. So we have 100 plus 110. So the investment value becomes 110. People might be willing to take a lot of risk with the investment return of 10. And again, this is not really rational because end of the day, the value of the investment is now 110. The money that came through return versus the money that was originally invested is not inherently different. So people, by creating these 2 different layers, the layer of the original investment versus the layer of return, might take undue risk with the extra money, and that theoretically does not make sense. So how do we overcome the bias? One is to recognize the drawbacks of putting money in different buckets. I've already talked about that. The major drawback is that we lose out on the diversification benefit. Another way of overcoming the bias is to combine all the assets on one spreadsheet. So we might have these 3 separate layers. If we put all the investments on one spreadsheet, then we can understand the true allocation across the various layers. And a third strategy is to focus on total return. So here the idea is to focus on total return instead of dividing return into income and capital appreciation components. Now say you buy a stock that is increasing in value but does not pay dividends. You can always sell part of your stock and create an income stream. So I discussed this example earlier. Another way to overcome the bias is to focus on the total return instead of dividing return into income and capital appreciation components. So as I mentioned a short while ago, if you buy a stock for $100 and then this stock goes up to 110, and let's say you do want some income, you can sell some of your shares to generate an income. But the key is to focus on the total return. It is better to have a stock go from 100 to 110 versus having another stock that pays a dividend, but you only get the dividend of 5 and the stock remains at 100. So here you get an income of 5, but the total return is only 5%. In the other case, from 100 you go to 110, let's say no dividend is paid, the dividend is 0, but the total return is 10%. This situation of a 10% return is clearly better than the other situation where you only have an income return of 5%. So by focusing on total return, you can try and overcome the mental accounting bias. The framing bias is an information processing bias in which a person answers questions differently depending on how the question is asked or how the question is framed. In an investment context, we can say that a person will make a different investment decision based on how the investment is defined or framed. So, for example, if we say that 1 in 4 startup companies succeed versus saying 3 out of 4 startups fail, we are actually saying the same thing. But in the first scenario where we say that 1 in 4 startup companies succeed, we are putting a positive outlook, or we are framing this information in a positive way. Somebody listening to this is more likely to invest in a startup company. But when we put it the other way, this is a negative statement. We are saying that 3 out of 4 startups fail. Same information, but given how this is presented, the fact that it's presented in a negative way means that people will be less likely to invest in a startup. Now, if I give you an example from your own context, say you are thinking about preparing for the level 1 exam, and I say that 40% of people taking the exam will pass. So that is a somewhat positive frame. This information is being framed positively, and you might decide to take this on because you say, oh, there's a 40% chance of succeeding. What if I say there is a 60% chance that you will fail? Now, it's the same information but framed differently. It's framed in a negative way. So when you hear this, you might actually be discouraged. So again, keep in mind that a framing bias is where a question is answered differently or a different action is taken based on how the situation is framed. What are the consequences of this bias? Moving on to the consequences of this bias. With this bias, the willingness to accept risk is influenced by how a situation is framed. So I have illustrated that over here. And clearly, the willingness to accept risk should not really be based on how the question is framed. The willingness to accept risk should depend on the situation of the investor, not on how the question is asked or how the investment is framed. So this bias can lead to misidentifying risk tolerances. And if the risk tolerances are misidentified, the risk of the investor is not properly understood, then we might end up choosing suboptimal investments because these investments will be based on how the information is presented and not on the actual situation of the investor. Also, this can lead to a narrow frame when evaluating investments. and that can lead to a focus on short-term price fluctuations. So how can the bias be overcome? One technique is to ask questions. So for example, we should look at whether decision we are making or the investment related steps that we are taking, are they the result of focusing on net gain or net loss positions? So are we investing somewhere by just looking at the net gain? So are we saying, okay, there is certain chance that the stock will go up, so there's a 30% chance that there'll be a certain gain, and then we are investing based on that? Or are we avoiding something based purely on the possible loss? So the key is to make sure that we are not just limiting ourselves based on how the question is being framed. And related to that is the fact that we should try to be neutral and open-minded when evaluating investments. And perhaps we can try and see through whether our decisions are based on how questions are being framed. And we can perhaps frame questions differently ourselves and frame them in different ways such that the statement being communicated or the information being communicated is really the same. And then look at whether we make a decision that is different based on how information is being framed. If that is happening, then we can recognize that there is a framing bias, and we should then obviously try and overcome that. An availability bias is where we take a heuristic approach to estimating the probability of an outcome based on how easily the outcome comes to mind. And therefore, easily recalled and understandable outcomes are perceived as being more likely. So if we can easily think of certain outcomes, then we just think that those outcomes are more likely. Or if we can easily understand some outcomes, then the outcomes that we can understand more easily, we think that they are more likely. Now, just to understand this term heuristic, a heuristic is a rule of thumb or a mental shortcut. So basically, this is a mechanism that allows us to try and easily understand something. So it generally involves a major simplification. It's important to understand the different sources of the availability bias. There are four major sources which are shown here. The first is retrievability. If an answer or idea comes to mind more quickly than others, it will likely be chosen as correct even if it is not. For example, a study was done in which subjects listened to a list of 50 names and were asked to judge if the list contained more men or more women. The list contained 30 generic female names, but there were 20 male names, and these were the names of 20 very famous men. Now, as availability theory would predict, most of the subjects concluded that the list contained more men than women because the subjects immediately recalled the names of the famous men. Next, we have categorization. When solving problems, people gather information from what they recognize as different search sets or different categories. If it is difficult to come up with the search set or the elements of a given category, then the estimated probabilities might be biased. For example, in the US, baseball is a popular sport, but soccer is not so popular. So if we have one set or one category for baseball and one category for soccer, and here if an average American thinks about baseball players, he'll come up with many baseball players, but he'll not be able to think of many soccer players. So if an American is asked whether they are more famous baseball players or more famous soccer players, he might incorrectly assume that they are more famous baseball players because in his baseball category, he just knows many more players. Next, we have narrow range of experience. This bias occurs when a person with a narrow range of experiences uses a narrow frame of reference which is based on his limited experience. So, for example, someone might have only 3 years of experience. So, we have an investment advisor who has 3 years of experience, and then he makes conclusions based only on this 3 years of experience. In these 3 years, he might have only seen stocks going up. And if he doesn't look at what happened before, just focuses on his experiences, obviously the decisions that he makes or the recommendations that he makes will be biased based on his limited experience. And the fourth source is resonance. The conclusions or decisions people make are often biased by how closely a situation resonates with their personal interests and experiences. For example, jazz music lovers are likely to overestimate how many people listen to jazz music. On the other hand, people who dislike jazz music are likely to overestimate the number of people who dislike jazz music. So there is a tendency to think that other people are also like me, and a tendency to overestimate situations which resonate with one's own beliefs and experiences. One of the consequences of this bias is to choose investments, investment advisors, or mutual funds based on advertising. Because when something is advertised, that is right in front of us, it's easy to recall, and often advertising makes things look very simple. If we are making quick decisions based on advertising, we might be suffering from availability bias. The availability bias can also result in a limited investment opportunity set, because we are focused on the opportunities or investments that easily come to mind, or those that are easily understandable. Because of this, we might fail to diversify. We might also fail to achieve an appropriate asset allocation. With respect to overcoming the bias, we should try and recognize that the bias exists. It is human tendency to overemphasize the most recent events, and in an investment context, it is reasonable to overestimate the most recent financial or investment related events. So we need to recognize that fact. We should try and develop an appropriate investment policy strategy, do careful research, and analyze investment decisions and focus on the long term. We should ask good questions. For example, we should ask whether we have considered all options. We should also look at where we saw the information that we are considering, and are we trying to consider a whole set of different sources of information. And we should also recognize that we forget events that happened several years ago. So we should recognize that we tend to focus on what happened in the recent past, but obviously to make decisions that will impact us in the future, we should not just focus on what happened in the recent past, we should also look at what happened before that. So that brings us to the end of the biases that fall under cognitive errors. So these are basically statistical information processing or memory errors that result in faulty reasoning and analysis. We should recognize the two categories. So there is belief perseverance, which has to do with memory errors or the way in which our beliefs are preserved. And then the other category is information processing. So statistical and information processing errors fall in the other subcategory. In general, to avoid cognitive errors, we should be vigilant and recognize that these errors do occur. We should ask good questions. We should keep a record of what happened, and we should synthesize data. We should follow a systematic approach. And if we do these things, then it is relatively easy to deal with cognitive errors compared to the next category that we'll talk about. And that next category is emotional biases.